We're joined now by Shaun Le Roux from PSG and, of course, still in studio, my co-host Ashraf Mohammed from Regiments Fund Managers. The PSG General Equity Fund has been managed by Shaun since 2002. It is a multi-award winning general equity fund which may invest up to 25% of its holdings in foreign stocks and 75% of its holdings in equities at all times. The fund has a good long-term track record. At the end of September 2011, the fund was ranked third out of 38 funds in the sector, going all the way back to March 2002. Shaun, thanks very much for your time. We've spoken about your philosophy before, and I think you've got to throw forward to it again for the sake of our viewers. It's the 3 M's. It underpins your philosophy: moat, management, and margin.
Bronwyn, that's absolutely spot on. And I think as we spoke last time, I guess what we're looking for is companies with a sustainable competitive advantage, being the moat, looking for a decent and competent management team that invests capital for the benefit of shareholders, invests alongside shareholders, and most importantly, what are we paying for those assets, the margin of safety. And our whole process is orientated towards looking at companies in that very structured fashion and trying to find companies that meet our criteria.
Right now, you are heavily into the offshore story because you see more value in equities in that environment. As we set up at the top of the interview, you can have up to 25% offshore.
Yeah, the offshore story has been a recent foray as far as our domestic equity fund is concerned. Our multi-asset funds have had full weightings offshore for quite some time, and their preference within the asset classes has been global equities. And really our view on the world is very simple. The way we look at companies, looking for companies with a competitive advantage that have the ability to compound that competitive advantage into the future. When we look offshore, we see some wonderful global leaders that look to us like they're trading at pretty reasonable valuations. And when you look at the other opportunities in the world with interest rates as low as they are, quality companies paying you a dividend yield of 4% plus with fantastic multi-decade track records feels to us like really not a bad place to be. And as I said, accordingly, we've taken money offshore in our domestic equity fund as well. The opportunity has become too compelling, particularly if you look at it relative to the domestic opportunities.
A compelling argument for offshore investing.
Absolutely, and I don't disagree with that particular argument. There are a number of banks in the US and Europe that are certainly far more attractive than South African banks, and I'm not talking about the big ones. There are some very niche banks. If one looks at some of the Swiss private banks, really private client money, decent margins. But I wanted to ask Shaun about his margins in terms of the 3 M's. Do you have a base margin below which you won't consider a stock?
Typically, Ashraf, when we're talking the margin of safety, our objective is to pay 60 cents for something that's worth R1. We all know if we come into a stock at an expensive price, permanent capital losses is something we could incur. So if we're looking at a company where we believe the moat and the management team is not that great, we're really looking for a very large margin of safety before we would consider an investment. Similarly, if we're looking at a company with a strong management team, with a strong competitive advantage, we might accept that the margin of safety isn't great, and at times we'd actually pay for some growth and be happy to be invested, understanding that company will compound shareholder returns over the long run. That's really what we're looking for.
So just in short, to take you back to what Bronwyn and I were discussing earlier, construction companies wouldn't really fit into the 3 M's.
Typically they wouldn't, you're quite right. We wouldn't look at the construction companies as great investments. Our view would be that they have very limited competitive advantage. 1 or 2 of the businesses have decent management teams with good track records, and we would tend to look at those more closely, the likes of a WBHO. But we can't discharge our responsibility as far as margin of safety is concerned. So unless we were absolutely convinced that they were trading at a significant discount to the worth of their assets, we would tend to look elsewhere.
Let's look at a couple of stocks that perhaps showcase your investment principles in the offshore space, and let's start with Tesco. That stock has been beaten down because of concern over the UK economic environment. But I see in your notes you point out that 60% of the floor space attributed to Tesco actually sits outside of the UK. So perhaps there's a lot more to the story than meets the eye.
I think that's quite right. You know, if we look at Tesco, clearly people are worried about the UK economy. We've got price wars in food retail in the UK, and people are focused on that. They're not looking at the company as a whole. They're not looking at its track record as far as we're concerned. And you could buy the likes of a Tesco on under 10 times earnings a few weeks ago. And, you know, point out that, you know, the domestic darling ShopRite trades at 23 times earnings. You know, 10 times versus 23 times is quite a difference, and there's quite a big growth differential priced in there. And if you look at Tesco, it's one of the best retailers in the world. Its track record, its market shares, its margins speak to that. But yet at the moment, people are singularly focused on the issues in the UK. And that's where the opportunity arises as far as we're concerned.
Just on Tesco, how much of its earnings come from so-called growth or emerging markets?
The actual earnings side is around about 30% as far as I recall. But again, you're speaking to a footprint, and for example, the opportunity in Korea is immense. You know, if you look at South Korea, you're looking at a population that approximates that in Great Britain. They're looking at a floor space of similar size, but you're looking at profits that are significantly lower. So we'd look at that and say, here's a 10-year opportunity that could be absolutely enormous. We're paying very little for that at the moment, and that would get us excited.
Now, you've also highlighted Berkshire Hathaway, which is looking very cheap at the moment. And of course, the man himself, Warren Buffett, is saying that you need to buy when others are fearful and sell when others are greedy. So at this point, do you think people are fearful of Berkshire Hathaway? Why is it so cheap at the moment?
Again, most of Berkshire's assets are US based. There's a strong financial exposure in the portfolio. And it's worth noting that Warren Buffett instituted a share buyback a few weeks ago. Now, this is the first time that he's done that in many, many years, and it speaks to the extreme valuation opportunity that he sees in his own company. Again, I think it's just a further backup to what we're saying about the extreme valuations that are available in some high-quality stocks, and Berkshire would be one.
Would you be backing Buffett at this juncture?
Well, I just wanted to allude to Shaun that there are a few reasons why Berkshire's gotten this discount over the past few months. I mean, the first being Buffett hasn't really gone out and said, here's my successor. It's a question that's lingered for the past 5 to 10 years as to who's going to take over. And then one of the key members of that list of successors goes and trades a share, you know, outside of the rules. So he has to be bumped off. So I think all that uncertainty caused by those problems has actually held the share back. And Goldman Sachs is still a fairly big holding of his, and lots of bad news around that business, not only
well,
in
a loss
terms of
in
earnings,
third quarter earnings,
but it's
420
also
million
governance
rand loss
issues.
for Goldman Sachs.
Yeah, governance issues around Goldman Sachs. So I think, you know, rightly there is value, but one has to be patient in terms of that value.
Yeah, we would take a slightly different view, and we understand the market fears at the moment, and we would take a view that while Berkshire without Warren Buffett, you know, it's possibly not going to be the same business, but we think he's put in place a system for continuity. If we look at the way they go about investing, if you look at the people that he surrounds himself with and the people he's looking at appointing, it's people that are cut from the same cloth. And we would look at the business and try and assess its intrinsic value, and we'd include the operating assets and put a reasonable price earnings on that. And on that basis, we think the stock is grossly undervalued. And within the portfolio is a lot of the types of companies we like, Tesco ironically being one, and that's a company that Warren Buffett's increased his stake in the last few weeks. So I think we would be speaking to the quality of the assets, to the track record in terms of compounding returns, and the price we're paying.
Unilever is another stock that I'd like to discuss on the desk. I haven't discussed Unilever for some time. Your thoughts, again, this is obviously looking very cheap in your book, but it's a quality business that is looking cheap.
Yeah, we think Unilever is a fantastic opportunity, and again, it's a long-term opportunity. It's a company with an outstanding franchise. It's got best-of-breed emerging market exposure in the of all the consumer staples businesses, 50% plus. It's taken tremendous efforts to turn the business around in terms of extracting full value from its franchise, and we're seeing improving margins right across the board. We're seeing improving innovation rates, which speak to a company that's starting to get on the front foot. And it's had a reasonable trot as far as the share price is concerned. But still, if you take a 5-year view and you look at what the company's the growth that the company is capable of generating, even in tough economic conditions, we really don't think you're going to go too badly wrong if you invested in Unilever.
Your thoughts on Unilever, Ashraf?
I think it's a great company. It really has grown substantially in terms of its exposure, not only in a country like India, but also within Southeast Asia. I mean, you know,
so you agree wholeheartedly with Shaun on this one?
I'd definitely go with Shaun in terms of Unilever. I think, you know, being an Anglo-Dutch company, they saw the opportunities in emerging markets well ahead of their American counterparts, and they've taken the lead on that.
I just want to chat about the broader economic environment, because the one thing that we do have clarity on is that we are in for uncertainty going forward. There are startling twists, turns and tumbles in the economic environment, both locally and globally. Are you ignoring the news flow on the international side of things? It's opening up, obviously, opportunities from a valuation perspective, but you're just holding firm with your investment case.
Look, we would predominantly be a bottom-up house, which speaks to looking at the specific companies. We don't know any more than anyone else about what's going to happen in Europe or what's going to happen in China. And to be frank, we're quite concerned about what we're seeing. It just speaks to a world where the outlook is uncertain, the outlook for earnings is uncertain, hence one can expect wild swings in share prices. Now, wild swings in share prices do generate opportunities, and a lot of the types of companies that we've been talking about are types of companies that will grow their earnings and grow their dividends in most scenarios. And yet they trade in our view, at fairly reasonable valuations. We would be focusing on that rather than trying to guess exactly what's going to happen in the European Parliament, etc., etc. But one is very mindful of the risks, and we would be the first to acknowledge that there are tremendous risks out there.